While most people are focusing on inflation rates, interest rates, and everything in between, there is apparently a housing super cycle that's about to play out. Now in this video, I want to share with you my thoughts around what will the interest rates do for property prices, how you can position yourself, especially if you haven't entered the property market, because I imagine it would be quite scary to see the market move further and further ahead while you're not in the property game. So in this video, I'm going to break it all down for you. And if you guys want to hear my thoughts, then definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now it's very important that you know how real estate works because in Australia, a large portion of people have their wealth in real estate. If you think about all the millionaires that come about, a large portion of them park their money in real estate. That's why we find this weird situation where the rich get richer, the poor get poorer. And unfortunately, that system will not change. And that's why my job here is to educate you to then learn what the rich people are doing so you can eventually get there as well. I've spoken about the death of the middle class. That is definitely playing out and it's been playing out for the better part of the last couple of years. If you're interested in what my thoughts are with the middle class and how it's being destroyed, definitely go check out this video. I promise you, you're gonna walk away with some value and some eye-opening things. Now, as I do, I'm a bit of a nerd and I go out and I look at some articles, I research, and something that caught my eye was this article. 3 reasons the housing supercycle is just getting going. Residential property seems to have a remarkable ability to keep appreciating whatever the weather. It will probably defy gravity even more insolently in the coming years. Now, it's that whole argument that real estate always continues to go higher. I'm gonna challenge that view. I don't think real estate continues to go higher and it always goes up. And I don't think it's just uniform. So if we go, oh, there's a super cycle, that means my 1-bedroom unit in Western Sydney is gonna grow. No, that's not how it works. You've got to go, that's the macro. When I start going into the micro and I find that in that area, there's more supply, there's more incoming supply relative to the demand, that means on the macro, it should go up. But in the micro, it's actually going backwards. And I'm gonna pause here for a second. I want you guys to think about this realistically and logically. If you think about it, there's people out there that now can borrow and the macro is looking really good. So let's just assume inflation's under control, interest rates have cut, everyone's happy, new jobs are getting created, and the markets are moving higher. In that market, do you want to be in a high performing market or a low performing market? Because if the macro is really good, that means all of the great areas are going to continue going higher, but the not so great areas are going to fall backwards. Now, your wealth during these times would be absolute catastrophe. And I'll tell you why. Because imagine you've bought a home and it seems to be a 1-bedroom or 2-bedroom apartment in an area that doesn't really make sense. In that area, because you wanted to take advantage of grants and you thought, hey, I just got to get into the property game, property always goes up. So you go and purchase this. And let's say in that year, your property goes down by 5%. But if the macro is looking great and the rest of the market goes up by 5%, you're not only falling back 5% in terms of your net worth and in terms of being wealthier, you're actually falling back by 10% because your property went down by 5% and the macro market went up by 5%. Okay, so that's a 10% difference. Now, if you think about it, during 2022, if you had property in Sydney, the markets generally moved down between 7 and 10% during that time. All of the properties we purchased were in areas outside of Sydney. And those clients are really happy now because they purchased in a market where the macro looked crap, but their properties all went up. So if the macro looked crap and national prices went down by say 5%, if you held property in Sydney, it went down by 7 or 10%, but your property went up by say 10 or 20% during that time, you're now getting further ahead, not just by 10 or 20%, but it's 10 or 20% plus the 5% or the 7% the rest of the market's involved in. This is why I go back to the strategy of rent vesting. When times are tough, it's not easy to go and purchase a $2 million property in Sydney, right? If you're in Sydney, you're in Melbourne, you're in Brisbane, you're looking at purchasing property, your dream home, yes, you can go and purchase that one property. But if the macro is not looking great, you're going to be in an asset that even if it falls by 10%, on a $1.5 million home, that's $150,000. If the market's not looking great and it's crap everywhere, I would much rather be in a property that's worth $500K that moves back by 10% because I've only gone backwards by $50,000. Generally what you'll find is when times are tough, the money starts flowing into the more affordable assets. It's exactly what we've seen over the last 24 months. So if we did see some sort of crash or correction in this market, I know which asset I would much rather be in. It's definitely not the $2 or $3 million property. It's more so being in the properties between sort of 400K and 700K where I've got really good cash flow, because that's going to stop me from actually selling that property. Now I know I've gone on to a tangent, but if you want a full breakdown of exactly what my strategy is, if the market is to crash, how I would then prep and what I would be purchasing, definitely let me know in the comments down below saying property crash with Ravi, and I'm gonna make that video for you. It's a tasty one, but let's get back into this. After the financial crisis of 07-08, global house prices fell 6% in real terms. But before long, they picked up again and sailed past their pre-crisis peak. When COVID-19 struck, economists reckoned a property crash was on the way. In fact, there was a boom, with mask-wearing house hunters fighting over desirable nests. Then from 2021 onwards, as central banks raised interest rates to defeat inflation, fears mounted of a house price horror show. In fact, real prices fell by just 5.6%, and now they are rising fast again. Housing seems to have a remarkable ability to keep appreciating whatever the weather. It will probably defy gravity even more insolently in the coming years. Now, what's important is to know why assets appreciate during times like this. It's not because the houses are suddenly better. It's because how much money is in the system increases during that time, and the dollar value actually depreciates. What I mean by that is $1 today is not the same as what it was worth 20 years ago. That's why house prices aren't worth what they were 20 years ago. The currency that you denominate that purchasing in is actually losing its value. So if the asset is here and it's a hard asset, that's going to hold its value. But the currency that you're buying it in is going down. It's gone down by over 90% since its introduction into the system. This will appear, being the house, will appear like it's more expensive and it continues going higher. But in fact, it's staying in the exact same spot. It's the currency that keeps going down. And so that's why as a byproduct, you'll see the asset actually going up during that time. And that is very important to understand, because it means there's more money in the system, right? When you had something like the financial crisis, you had so much more money being printed into the system. Now, if you think about it, during the whole pandemic lockdowns, you had more than 10x the amount of money printed during that time. Now, all these governments hold large amounts of debt, and they need to go and fund that debt. And they would much rather fund that debt at lower interest rates than higher interest rates, just like I'm sure you understand because you have your own home loan. Although on a much smaller scale, it's effectively the same thing for governments and central banks around the world. The history of housing involves a once unremarkable asset class turning into the world's largest. Until about 1950, the rich world's house prices were steady in real terms. Builders put up houses where people wanted them, preventing prices from rising much in a response to demand. The rollout of transport infrastructure in the 19th and early 20th centuries also helped temper prices, argues a paper by David Miles, formerly of the Bank of England, and James Stephan of Imperial College London. By allowing people to live further from their places of work, better transport increased the amount of economically useful land, reducing competition for space in urban centres. Now, we haven't even seen interest rates cut, but let's just take a moment to think what that would look like. Now, yes, if the interest rates are cutting, it means the economy is not healthy. When the interest rates are rising, the economy is healthy. But the economy and what it does versus what share markets and property markets do are completely opposite. In some cases, they do correlate, but in this case, not really. Because when interest rates were increasing, property prices actually fell. But in fact, it should do the opposite, right? Because the economy is really healthy, people are employed in jobs, so why would property prices go down? And it's because when we purchase real estate here in Australia, we're largely taking up 80 to 90% of that property price in debt. And if people can't access that debt, then unfortunately you can't buy that property, because not everyone's walking around with $1 million or $1.5 million in their pocket. So what we do is we say, we'll put a 10% deposit into the house, 90% will come from the banks. But in order to get that loan, you need to have what's called borrowing capacity. Right now, if interest rates are where they're at and you can't borrow, that means you're out of the market. You unfortunately have to sit on the sidelines and watch property prices go up and everyone saying, hey, look, I bought this and I bought this and I bought this, and it all went up. Now what's going to happen is interest rates will cut. In the next 12 months, they will start cutting. Now, how deep they'll cut, how fast they'll cut, not sure. But if history is anything to go by, the pace at which we go down is a lot faster than the pace at which we went up with. So if you know, you know. Now in this case, every 100 basis points or 1 percentage point difference on the mortgage rate, it actually increases your capacity to borrow by 20%. Now that could be the difference between you purchasing a place for 500K or 600K. And the other thing you've got to factor in is that right now, if say there's 10 people allowed to borrow, right now they can purchase property in an area that say has 12 properties available. That means demand is lower than supply. But if now suddenly you have interest rates cut, you'll have that number or pool of people that could buy could increase from 10 to 12 to 16 to 18 to 22. And that doesn't mean that automatically you have more properties available for sale. In fact, during those times, we could see the supply of properties actually diminish. And so if we haven't even seen interest rates cut, and now we're seeing housing investors borrow at the highest level in more than 2 years, it means that people are now entering the market that were sitting on the sidelines but had the ability to borrow. So this is where we enter phase 2. Phase 1 is anyone that can borrow, has borrowed, and has bought assets. Now phase 2 is people that could borrow but didn't borrow because they were scared that the market was going to shit itself and interest rates will continue higher. They are now entering. And then there'll be phase 3. Phase 3 is when everyone can borrow and everyone wants to buy property. And you can see now why my argument for why I don't think a property crash is coming anytime soon is because we haven't even entered phase 3 yet. I would go on to argue that we've only just entered phase 2, which is people that can borrow are now borrowing. Investors are taking advantage of weaker housing markets, borrowing more than any time in the past 2.5 years. While first-home buyers struggle with sustained high borrowing costs, new official figures show. New investor home loans commitments rose 1.4% to 11.7 billion in August, the most since Jan 2022, when the cash rate was 0.1%, as new borrowing by first home buyers slipped less than half a percentage point to 5.3 billion, the ABS said on Friday. Now, I'm not sure if you know about this, but I've got another channel on YouTube, and it's called the More Than Money podcast. I put up podcasts that I have with people that are really smart, much smarter than I am, so that you can leverage the learnings from them. So if you are interested, subscribe to that channel. I'll leave a link up here as well as a link in the description below. And the reason I say that is because the next person that I'm about to reference is actually a guest on that podcast. And she is a wealth of knowledge. Narita Conisbee is the chief economist at Ray White Group. And she's got an article here that I want to reference. With a rate cut on the horizon, we are again at a turning point for Australia's property market, making it timely to take another look at what drives price growth. Right now, Melbourne and Sydney are slowing down rapidly, while Southeast Asia and Perth continue their strong run. We looked recently at what happens in the month following an interest rate cut. However, there are a lot of other drivers which can often make a bigger difference to price movements. So keep in mind, interest rate's only one component. If you go in and say macro looks great, but your market looks crap, it's still going to underperform what's happening in the market. But this is really cool to see. So if you look at this, this is Australia house price trends during cash rate adjustments. And what we can see is we've got information here where in the yellow, it's a rate cut, and in the gray, it's a rate hike. So over here, just after the GFC, we had a rate cut and we saw prices go up, and then we had a rate hike. But what we saw was a slower decline in prices before we started moving higher. And then we can see all of the rate cuts that have occurred during that time. And during this time, we've seen a massive bull run in property prices. We then started seeing another interest rate cut here during the time of the pandemic. We saw property prices go much higher. But in this portion here, we saw property prices fall for the first time after a few years. And that was largely due to the fact that the banks had changed up their lending procedures. We had responsible lending come in, and we had APRA step in, change up some rules, and that spooked a lot of investors. But it also meant that a lot of investors couldn't go and purchase more properties. So that's why we saw the decline there. And this is why interest rates are only one piece of the puzzle. What we saw was prices absolutely take off during the lockdowns, and then we saw rate hikes come in. Although rate hikes have been going on for this period of time, we saw property prices initially dip, but since then they've continued much higher. Now let's look at this monthly percentage change in house prices following a rate cut since Jan 2011. And what you can see here is Sydney has gone up by 1.4%, Melbourne by 1%, Canberra by 0.5%, Brisbane by 0.4%, Adelaide by 0.3%. And that averages out to be about 0.6% increase. Now, what this does tell us is that markets that are priced a lot higher are more sensitive to interest rate changes. So that's why when interest rates started going up, we saw Sydney and Melbourne get affected the most. Now, if we do see interest rate cuts, we're going to probably see Sydney and Melbourne rebound the fastest. Does that mean you should go out there and buy anything in Sydney and Melbourne? No, it does not. Because again, we need to factor in the macro looks great, but the micro looks crap. And if you're getting into an area and all you can afford is an $800,000 apartment, I'm sorry, but unfortunately, most of them will not grow. And that's on the basis that you hope nothing goes wrong with that actual developer or the builder, as well as any issues to the actual building, because we've seen a few of those over the last couple of years. Now, one graph that is very promising is construction cost increases are easing. what we did see during the pandemic is the cost to actually build a new property increased by a lot. Now, this is important to note that this is a percentage change. So although this number looks like it's going down, it doesn't mean that the cost of construction is cheaper now. It just means that the rate at which it's growing is a lot lower. So that does mean it's still increasing, but it's not increasing at 15 or 20% like it had been the last couple of years. And the reason I say this is important is because if construction costs continue to rise, it's inbuilt into the property, where developers have two choices. One, they build, and they build for profit, right? So they're gonna have to sell it for more than what it cost. So as long as this number goes up, property prices have to go higher. But they also have another choice. If there's no demand in the market and no one wants to buy, they'll just stop building, because it doesn't make sense for them to actually go and build something they're going to lose money on. And that therefore means there's an extra pressure on the market, which means they need property prices to go higher to be able to build more properties so they can actually transact on that property. It is such a confusing time. I've tried my best to simplify what's happening right now. If you're interested in more thoughts around what's happening and keeping up to date, definitely go and subscribe to the channel. I make videos like this every week, and I've also got it ad-free on Spotify as well. So if you're hearing half of it and then you want to hear it in the car on the way to work, you can access the videos there as well. I hope you guys have enjoyed this video. If you have, smash that like button, subscribe if you haven't already, and I'll catch you guys in the next one. Thanks, guys.